Credit cards can help build your credit, protect purchases, track spending, and even earn rewards. They can also turn one ordinary purchase into years of payments. The difference is not the card itself. It is whether you understand three things most borrowers overlook: the minimum payment, the APR, and the true cost of sending today's spending into tomorrow. In this video, we are going to expose the hidden traps inside credit cards and loans, separate useful borrowing from destructive debt, and build a smarter way to use credit without letting it control your future. And one warning matters more than almost everything else. A good credit score can still hide a financially fragile life. Let's start with the trap that looks harmless: the minimum payment. Imagine using a card for groceries, then gas, then a small emergency, a few clothes, and eventually a vacation you plan to pay off quickly. At first, nothing appears broken. The minimum payment is small. The card still works. The account is current. But the minimum payment is designed to protect the account, not necessarily your future. It may keep you from being late while allowing the balance to remain for months or years. That is why people can make payments consistently and still feel as if the debt barely moves. When the interest rate is high, a large part of each payment can go to the lender before it meaningfully reduces the balance. And credit is expensive. As of the first quarter of 2026, total U.S. household debt stood at approximately $18.8 trillion. Credit card balances accounted for about $1.25 trillion. By the second quarter, the average credit card APR was about 20.94% across all accounts and 22.15% for accounts that were actually charged interest. Those numbers matter because APR is the real price tag of borrowing. A product does not cost only what appears on the receipt. When you carry a balance, the true cost becomes the purchase price plus interest, fees, time, and the future cash flow committed to repayment. A $2,000 television paid in full costs $2,000. The same television carried on a high-interest card and paid slowly can cost far more. And here's the painful part. The television gets older while the debt stays young. That is why a credit limit is not permission. It is access with terms. Approval only means a lender is willing to let you borrow. It does not mean the purchase fits your budget, your goals, or your future cash flow. The bank decides what it is willing to risk. You still have to decide what you can truly afford. That distinction also explains why a credit score should never be confused with wealth. A credit score reflects how lenders evaluate your borrowing behavior, payment history, amounts owed, length of credit history, new credit, and credit mix all matter. But the score does not show your emergency fund. It does not show your net worth, investments, monthly stress, or how dependent you are on your next paycheck. Someone can have an excellent score and still be one emergency away from financial trouble. So protect your credit, pay on time, keep revolving balances low, and avoid unnecessary applications. But remember the larger goal. You are not trying to become excellent at borrowing forever. You are trying to build a life that needs less destructive borrowing over time. Now consider one of the most attractive features of credit cards: rewards. Cashback, points, miles, fraud protection, and purchase tracking can be useful, but rewards stop being valuable when interest enters the picture. If you earn 2% cash back while paying more than 20% interest, you are not beating the system. You are paying the bank far more than the reward is returning to you. A disciplined user treats a credit card almost like a debit card with additional protections. The card is used only for spending that is already planned and supported by available cash. Rewards are collected only after the balance is paid in full, because the reward is not the strategy. Avoiding interest is. The same principle applies to credit utilization. Utilization measures how much revolving credit you are using compared with your available limit. A common beginner guideline is to remain below 30%, and lower is generally better. But do not mistake a credit score guideline for a complete financial plan. A person can have low utilization and still carry debt they cannot comfortably repay. The healthiest outcome is not merely a lower percentage. It is controlled spending, reliable cash flow, and paying the balance in full whenever possible, because debt costs more than interest. It costs flexibility. Every required payment next month is future income that has already been assigned. Credit cards, car loans, student loans, personal loans, buy now, pay later plans, medical debt, business loans, and mortgages can all reduce what your future self is free to do. Debt turns future income into payment for past decisions. Sometimes that trade can be worthwhile. Sometimes it quietly drains your life. This is why we need to separate builder debt from drainer debt. Builder debt has a clear purpose, a reasonable cost, manageable risk, and a realistic path to producing long-term value. A mortgage may help build equity when the home is affordable and the buyer has reserves. A student loan may be strategic when the total cost is reasonable compared with the likely earning power of the qualification. A business loan may help when there is proven demand, clear pricing, healthy margins, and a credible repayment plan. But the label alone does not make any of these debts good. The numbers decide. A mortgage can strain cash flow. A degree can cost more than the career can reasonably repay. A business loan can multiply losses when the business model is unclear. Drainer debt is easier to recognize. It usually funds lifestyle, image, impulse, emotional spending, or assets that lose value quickly. Vacations, expensive dinners, gadgets, furniture, clothes, and unnecessary upgrades are not automatically wrong. The problem begins when temporary enjoyment becomes a long-term obligation. Borrowing for lifestyle is spending tomorrow's freedom today. Car loans are one of the clearest examples. Many buyers focus on the monthly payment because that is the number placed in front of them. A dealer can extend the loan term and make an expensive car appear affordable, but the lower payment can hide a much higher total cost. Once interest, insurance, fuel, repairs, maintenance, and depreciation are considered. A manageable payment is not always a manageable purchase. Student loans deserve the same level of scrutiny. Education can create enormous opportunity, but student debt is not automatically productive. Ask what career the program supports, what income is realistic, how much must be borrowed, what repayment options exist, and how long the debt is likely to remain. Do not evaluate only whether you can obtain the loan. Evaluate what the loan is expected to produce. Business borrowing follows the same rule. Borrowing for inventory with proven demand and healthy margins may strengthen a business. Borrowing for a vague idea with no customers, pricing model, or cash flow plan may simply turn uncertainty into a monthly payment. Debt can build or drain. Purpose matters. Cost matters. Cash flow matters. Risk matters. Now, what should you do when the debt already exists? Start with clarity, not shame. Shame makes people avoid statements, ignore APRs, and continue making minimum payments without confronting the full picture. Clarity puts the numbers back under your control. List every debt. Write down the balance, APR, minimum payment, and due date. Then identify whether each obligation is building something valuable or draining your future cash flow. Once you can see the full picture, choose a repayment method. The avalanche method targets the highest interest rate first. Mathematically, it will usually reduce the total interest paid. The snowball method targets the smallest balance first. Psychologically, it can create momentum because accounts disappear faster. Avalanche wins on the math. Snowball may win on behavior. The best method is the one you can follow until the debt is gone. But whichever method you choose, stop adding new debt while paying off the old debt. Otherwise, you are trying to empty a bathtub while the faucet is still running. Debt consolidation may help when it lowers the interest rate, simplifies repayment, and is supported by changed behavior. But if you move card balances into a personal loan and then begin using the cards again, you have not solved the problem. you've relocated it. Consolidation without discipline is debt with a new address. Before borrowing again, ask 3 questions. What is this debt for? What will it cost in total? What is the realistic repayment plan? If any answer is unclear, pause. Credit is like fire. It can cook your food or burn down your house. The tool is not automatically good or bad. The outcome depends on purpose, cost, and control. Used wisely, credit can help you rent an apartment, qualify for a mortgage, fund education, support a proven business, protect transactions, and build a reliable payment history. Used carelessly, it becomes a way to avoid budgeting, delay discomfort, manage emotions, impress other people, or live beyond your cash flow. And the trap rarely looks dramatic at first. It looks like one swipe, one minimum payment, one balance transfer, one longer car loan, one reward offer. Then, months later, part of your future income already belongs to decisions you barely remember. The good news is that credit can be controlled and a damaged plan can be rebuilt. Begin with a few operating rules. Pay every bill on time and automate at least the minimum so a forgotten due date does not damage your credit. Pay more than the minimum whenever possible, especially on high-interest balances. Keep utilization low, but prioritize eliminating carried balances rather than manipulating a score. Build emergency savings so the card does not become your emergency fund. Read your statements, know your APRs, review your credit reports, and use rewards only when you can pay in full. Most importantly, borrow only when the purpose is clear, the total cost is acceptable, and repayment fits comfortably inside your real cash flow. That is how credit becomes a tool again. Not something to fear, not something to worship, something to control. So ask yourself one honest question. Is your credit helping you build stability, or is it quietly making your future less flexible? The goal is not simply approval. The goal is to owe less, keep more, invest more, and gradually reach the point where interest works for you more often than it works against you. A credit limit is not wealth. A minimum payment is not a payoff strategy. And rewards are not rewards when interest costs more than they return. Use credit to build your future, not to decorate your present. Because every dollar lost to unnecessary interest is a dollar that never had the opportunity to build your freedom. In the comments, share the credit rule you believe more people need to understand. And subscribe to Financial Awaken with Aaron for more practical breakdowns of the systems behind debt, credit, and lasting wealth.